All right, let's get right into it. What we're about to do here is a forensic breakdown of a huge market event. We're not just looking at lines on a chart, no. We're investigating what looks a lot like a crime scene.
So, the date you need to remember is Friday, January 30th, 2026. For most of us, it was just another Friday, right? But if you were anywhere near the silver market, it was a day of just pure, unfiltered chaos. A day people are going to be talking about for a very, very long time.
I mean, think about this. In a single trading session, the price of silver just collapsed by 30%. It plunged from a high of around $121 all the way down into the low 80s. A move that big, that fast, it's almost unheard of. This wasn't some gentle correction. This was a liquidation.
And that really brings us to the big question of this whole explainer. Was this just the classic case of market panic? Everyone's selling at once? Or was this something else? Our deep dive into the data, well, it suggests this was a carefully, meticulously planned demolition.
All the evidence we've seen points to a coordinated, manufactured crash. This wasn't random, it wasn't an accident. It was a three-pronged attack designed to get a very specific result for a few very powerful players.
So how did they pull this off? Well, the evidence shows us there were basically three kill switches that got flipped almost at the exact same time. First, a sudden margin hike to force people to sell. Second, a macro trigger to freak out the trading algorithms. And third, a hidden catalyst to create a wave of panic. Let's break down how they all work together.
The main weapon, well, it came from the exchange itself, the CME Group. They suddenly and just dramatically jacked up the margin requirement. That's the cash you have to put down just to hold a position. By making it insanely expensive, they basically put traders in an impossible spot.
And this is where it gets just wild. The CME announced that by Monday morning, traders had to post 45% of their position's value in cash. 45%. They were given just one business day to find that kind of capital. What are you going to do? Most traders had no choice. They were forced to sell right then and there on Friday just to avoid defaulting, and that created this absolute tsunami of selling with pretty much no buyers in sight.
So while that margin hike was forcing the sell-off, the other two attacks gave them the perfect cover story. First, you get news that a hard money hawk is up for Fed chair, which immediately triggers trading algorithms to just start dumping precious metals. At the same time, a Chicago bank fails, which creates a sudden scramble for cash, forcing hedge funds to liquidate their silver. To the outside world, it just looked like random market chaos, but it was all part of the plan.
So who on earth benefits from all this chaos? Well, the data trail leads directly to one huge player who wasn't just surviving the crash, they were orchestrating it. And this brings us to what we're calling the JPMorgan Heist.
So why this sudden, violent move? It looks like there was a mandate out there for the big banks to be flat futures, which means they had to be completely out of their massive short positions by January 31st. That deadline, well, it explains the incredible urgency and why they had to engineer a crash on the 30th.
And this quote it sums up the strategy perfectly. They smashed the paper price to get a huge discount, which let them close out their massive paper bets against silver for a tidy profit. But they did not stop there.
Here's the first piece of hard evidence for you. On the actual day of the crash, COMEX delivery notices show JPMorgan issued 633 of them. This is literally how they started settling those short positions.
And just look at this price. The settlement price on those notices was $78.29. They didn't just get out of their shorts, they got out at the absolute manufactured bottom of the market that they had just created. They closed out the paper game at maximum profit. But here's the real pivot. While the entire world was watching the paper price go up in flames, something else was happening in the physical world. A staggering 3.4 million ounces of physical silver were pulled out of COMEX vaults in a single day. And who was leading the charge? Yep, JPMorgan alone pulled out 1.64 million ounces. That's nearly half of the entire physical drain for the day. So they didn't just close their paper shorts. They sold paper and literally took home the physical metal. It was a masterful heist.
Now, if you need one single piece of evidence, one smoking gun to prove that this crash was totally artificial, that the US paper price was a lie, this is it. It's the massive disconnect between what was happening here in the West and what was happening in the East.
First off, just look at how absurd the paper selling was. On that one Friday, almost 2 billion ounces of paper silver were traded. That is literally double the entire planet's annual production of the physical metal. It was a phantom, a digital illusion of supply. And here it is, the aha moment. While the U.S. paper price was crashing down to $78, buyers in China were paying the equivalent of $101 an ounce for physical silver. Let that sink in. The West was dumping paper, while the East was desperately bidding for the real thing. A premium of more than $22 per ounce, that is undeniable proof. It proves there was a very real physical shortage being completely masked by these paper market games. You just can't argue with an arbitrage opportunity like that.
So, okay, let's pull all the pieces of this investigation together. Let's deliver the final verdict on what really went down during the Great Silver Liquidation.
It was, for all intents and purposes, a hostile takeover carried out by a group of co-conspirators. You had the exchange, the CME, changing the rules of the game right in the middle of play. You had the bank, JPMorgan, using the chaos to pull off a perfect pivot from a huge paper short to a huge physical long. And you had insiders using the public panic as cover to drain the vaults. And probably the most important takeaway from all of this is this simple fact. For years, JPMorgan's massive short position has acted like a lid on the silver price, holding it down. Well, based on everything we saw that Friday, that lid is now gone. They're not betting against it anymore. Which leaves us all with one final, pretty provocative question. The entity that was arguably the single biggest force suppressing the price of silver just closed out all its shorts and went long physical metal in a huge way. They just switched sides. So what happens now?